Hey everybody, Jim Hiles. It's Tuesday, tax day from First Capital and Go Plan 101. Let's jump right into a CRT, Charitable Remainder Trust. I really like these things. I've done a number of these in my career, and I think they work extremely well. We might want to look at these again, more so now that we know income taxes are going up. So this could be an opportunity for somebody to do good and also do well from a tax planning standpoint. So basically, what's a charitable remainder trust? We'll break down those words. Basically, it's an irrevocable trust. You can't change it once you've done it, and potentially generates an income stream to you. You're the donor to the trust, the person who gives the money. It is a charitable entity. The charitable beneficiaries get the money in the end. You get the income while you're alive. It's typically how they work. There are two different types. There's what's called a CRT, C-R-A-T, Charitable Remainder Annuity Trust. And this is kind of like a old-fashioned annuity thought process, right? You get a fixed annuity amount every year. Can't put anything more into it. It's locked in. The second one is a uni trust. A uni trust allows you to get a percentage of the balance of the trust, and you could add more to it in the future, a little more flexible. But they are distinctly different based on the payouts. For example, the annuity trust gives you a rate, you pay that rate. Let's say those rates are 3%, just making this up. You're going to get 3% of the principal balance, forever until you die. Then the assets go to charity. Uni trust is a little different. That fixed percentage is on the balance of the assets. So if you say, hey, I'm going to take 8% of the plan balance out every year, if that plan balance is invested and grows better than 8%, it becomes a higher payout in the future. It could also become a lower payout in the future. We like these things because you're basically making a charitable contribution. So keep in mind, this is a charitable gift. So think in your mind, it's not your money anymore. You get to keep the income stream that it generates. You get a partial income tax deduction. How big is the income tax deduction when you mean partial? You don't get 100% of the dollar coming back in income tax deduction. You actually get the present value of the future interest. In other words, you're not really making a gift until you die. Well, when are you going to die? Who knows? They go to the IRS table and says you're going to live this long, and they take that number and they bring it back to what's called a present day discount. You get the income stream. That's the good news. The charity gets the remainder amount. You can go to any charity you want. You can go to private foundations. So it's kind of a neat thing to work through the tax plan. Why would you do this? Let's say you got highly appreciated assets. When you sell something in a charitable remainder trust, you do not pay capital gain taxes. So you don't have to worry about this increase. So you put the money in there, you have no basis stock, everything you sell is going to be gain. If you sell it in that CRT, there's no capital gain tax to pay. So you're working with 100-cent dollars from day one. You're getting an income tax deduction based on the present value of that gift. That's going to be worth, a significant amount of money to you. And anything produced income by the way of return inside the trust is not taxable to you either. So the growth of the trust can grow in the future. You can be a beneficiary from an income standpoint of that growth. So we like CRTs, Charitable Remainder Trust. If you want to talk more about it, please feel free to give us a call. Thanks.